Okay, hello, welcome to our inflation and energy prices presentation. Now in this we're going to take a look at the correlation of the United States Consumer Price Index CPI inflation with energy sector prices, and particularly with the oil price. And then we're going to look a little bit further into the potential use of using the US oil price data, which is something that's traded on a daily basis, to forecast future inflation trends. Okay, the CPI. The CPI-U is published by the Bureau of Labour Statistics, the BLS, in the United States every month. The CPI-U itself is an all items index. It's what's called headline inflation, and it's normally quoted as a year-over-year price change, and it's for all urban consumers and basically for all goods and services. Now the CPI itself consists of various components. Each of these has a weighting in the index, and the main categories are food, which contributes about 14% of the index, about a seventh of it. Energy, which has about a 7% weighting, which varies slightly from season to season. Then commodities, by which they actually mean finished goods, retail goods, and apparel. So this is basically finished goods, the sort of things you buy for the home, non-durable and durable, and things like cars, new and used cars, and clothing, and all sorts of things like that contribute 19%. And then services, which are medicine, shelter, rentals, transport services, and the like, including insurance and things like that, contributes the largest chunk, which is 60% to the inflation index. There's also what's called core CPI, which is the headline CPI minus food and energy. Food and energy prices vary from season to season, and so once you take those out, the core CPI is less volatile, but it's kind of less relevant to consumers because it doesn't include food and energy. And the core CPI is meant to show kind of the degree of background or underlying inflation, but we're not really going to consider that here because this has been relatively constant and relatively stable over the last 2 or 3 years. Now the CPI itself, the overall inflation index, hasn't been so stable over the last 2 or 3 years. So here we're going from September 2014 to the end of 2016. Now in mid-2014 actually inflation was at CPI was about 2%. So in September 2014 it was about 1.7, and it really very quickly plummeted all the way down to negative territory, minus 0.1%, very slight deflation in January of 2015. Then it stayed for the whole of the first half of 2015 in this kind of region between about minus 0.2%, which was the low in April of 2015, between minus 0.2 and plus 0.2%, all the way actually till October of 2015, and then it began to climb. In the first half of 2016 we had approximately 1% inflation on average, and then it began to rise steadily to just over 2% by the end of 2016. So this first half of 2015 was a time of deflation basically, with CPI at 0 to minus 0.2 here, and then just basically just a tiny bit over 0 over across the summer of 2015. So what really was the cause of that? And so what we're looking at, what are the causes? Okay, headline CPI was near 1.7 in late 2014, as we've just seen. It dipped deeply into negative territory to minus 0.2% at the beginning of 2015, and gradually rose again during the next year and a half. Why did this happen? Because the core CPI minus food and energy changed very little in this period. It was really between 1.6 and 2.2%, whereas we've had a variation in the overall inflation rate between minus 0.2 and basically +2. So we've had a very wide change in overall inflation without the core CPI changing very much. And meanwhile, service inflation has been consistent at about 2.5% to 3%, and this really feeds in to the core figure because that's the main component of core CPI. So there must be another cause for this large variation in inflation. Well, perhaps it's energy prices. So what we're looking at here actually is the price of the main energy commodity, which is the West Texas Intermediate crude oil contract, which is traded on a daily basis. And what we're going to look at here is a 3-year oil chart, and you can see quite clearly that oil plummeted from the second half through the second half of 2014 into early 2015. In the middle of 2014 it was about $107 a barrel. It came down in around about February, March 2015 to the low 40s, which is a fall of more than half basically. And then we saw a little bit of a rally into the summer of 2015 to the low 60s, and then we saw another fall, well a double fall actually, in oil through the second half of 2015 to the low in February 2016, which was just over $26 per barrel. And since then we've seen a little bit of a rally in oil, and it's gone back up into the low 50s in terms of dollars per barrel. So we really need, because we're looking at inflation, to compare the year-over-year changes in oil. So I've marked some of those here, and it's plain to see actually that some of these big negative year-over-year decreases in oil corresponded to very low figures for CPI inflation. So basically in early 2015 and late 2014 you had CPI values of 0.8% at the end of 2014 going down to the low in March, April 2015 of minus 0.2. And then even though you had a little bit of a rally in oil in the summer of 2015, you're still comparing these prices with much higher prices the previous year. So inflation here was only plus 0.2, and again coming down to the lows in August of 2015, you're still comparing with much higher prices. Inflation here was about between 0 and plus 0.2. And as we're coming into 2016, actually the falls in oil are a little bit less steep, and we were seeing a little bit of inflation here, but not very much. It was still under 1% basically. If we expand a little bit to the 2-year graph, okay, we can see here that the low for oil in February of 2016, if you actually look at the month-end figures, there's a substantial decrease, but not a particularly steep decrease from the year before. And here inflation was 0.9 to 1%. And of course, actually what happened since then was that the oil price started to rise and the year-over-year figures started to flatten out. So in September of 2016 you're comparing it with a year before, and it's just very slightly down. It's really almost flat. And in October 2016 you're actually seeing the beginnings of a very slight rise in the price of oil. And so we'd be expecting inflation to rise and the energy sector prices to rise during that period. And actually that's what you see. You see a very gradual climb in inflation throughout 2016 as the oil price started to turn around. And indeed, as you're coming now into February 2017, we're starting to see the oil price turn up quite sharply. And actually from the low to the high that we've had on the day I took this chart, oil was $53.78, and compare that with a low of just over $26 in February 2016. That's almost 100% increase year over year in the oil price. So the oil price trend has gone from steeply negative, it's flattened out, and it's gone to quite steeply positive during the last couple of years. And that's really one of the main factors for the volatility in inflation. And having this uptrend in oil now, we could be expecting higher inflation. Now, if we look at the overall CPI and we look at the energy component, which is quoted in the BLS statistics, it's not just oil, but it's other energy commodities and services, electricity, natural gas, and things like fuel oil and gasoline, basically. I tried to fit 3 models to the actual inflation data, and you can see actually that they're very, very close. Blue is the CPI, so CPI is the blue graph, and I took the energy changes, the year-over-year energy changes, and tried to match them up to overall inflation, and we actually got the best correlation coefficient with the red model, which is just basically the percentage energy change multiplied by its weighting that particular month as quoted in the CPI, and the correlation is about 0.98, which is a very high degree of correlation. So almost all of the change in inflation between mid-2015 here and late 2016 is expressed by the changes in energy prices, because all of the other components of the CPI inflation statistics were roughly constant rate of inflation for just about everything else. Food, services, etc. were not really changing. It was only energy that was changing. Now, if you have a little look at a couple of examples of this, if we go back to the oil chart, I'm going to look at February 2016, I'm going to look at September, October 2016, and Feb 2017. And basically Feb 2016 CPI was 1.0%. The overall energy sector change due to the massive fall in oil prices was minus 12.5. Well, given the energy weighting was roughly 0.07, 7% of the index, the energy contribution to inflation would have been minus 0.84%, or approximately minus 0.8. In other words, the fall in energy prices was dropping inflation by 0.8%. So without that, you wouldn't have had 1% inflation. With flat energy prices, you would have had about 1.8% inflation. So to check this a little bit later in the year, in October, the change in oil prices and energy sector prices were flattening out and just beginning to go very, very slightly positive, but only 0.1% on the entire energy sector per annum, which is virtually zero. So basically, zero change in energy prices. The CPI was actually 1.7, which is very close to our ballpark forecast of 1.8. So imagine then if oil and energy prices reversed and turned sharply upwards, you would probably have this minus 0.8% energy contribution changed to something like plus 0.8, and this would add another 0.8% to inflation, which would add 1.6 to your 1.0 figure that you had in February of 2016. You might have a CPI of around 2.6%. Well, this is already happening. In December 2016, energy was actually up 5.4%, CPI was 2.1. January 2017, energy was up 10.8%, that's the first double figures change in energy, and CPI was 2.5, actually going a little bit faster than we expected. So as of February 2017 now, oil has doubled from its lows, and we would expect that to take a little bit of time to filter through into retail energy prices, petrol at the pump, and the utilities like electricity and gas and this kind of thing. So we think that it has not yet fully factored through and filtered through into the CPI. And the CPI for January, which came out, which was reported in the middle of February, was already plus 2.5. And we're expecting energy changes perhaps of plus 20%, which is going to send inflation up somewhat higher. So the initial conclusions that we have are that CPI inflation year over year is almost entirely dependent on energy sector price changes. It also shows a very good qualitative and indeed a fairly quantitative correlation to the West Texas Intermediate oil price contract year over year change in the United States. And in the background we've got service inflation, which is already at 3%, so inflation is likely to remain positive into the future. We're not likely to get deflation, therefore, unless something really bad happens with the economy. And considering that oil and energy year-over-year prices are now turning quite sharply up, we're expecting inflation to increase substantially, even if that's only temporary. And so we're basically forecasting a CPI inflation spike possible in early 2017 in the USA and possibly worldwide. And we're already really starting to see that come through. And in addition, it may well be possible to look at current oil price action, and this is something that's traded on a minute-by-minute basis daily, to forecast future inflation figures. Of course, if inflation figures are published basically a month out of date, because they're obviously taking surveys of prices in February, they're not going to report those until March. But we already, of course, have January, February and some of March's oil prices because it's traded every day. So we may be able to use the oil price action in this environment to forecast future inflation figures quantitatively. And we're in fact doing this. And we've got some reports and other articles on our websites concerned with that. So a quick preview now for February and March inflation reports. Now actually December's inflation was 2.1 and January 2017's was 2.5. So what's February going to be? This is going to be announced actually later today. It's the 15th of March. And February's inflation we're expecting to be really in the 3% region. Now I've taken, actually we've done 7 quantitative models by looking at correlation coefficients and linear regression and these kind of tools, and I'm showing you 5 of them here. These greyed out figures show how the models matched up with the actual inflation figures from December and January, and of course these results, the actual inflation figures aren't in yet for February and March, but this is what we are forecasting. Okay, the first model actually only forecasts a month ahead, and the other models actually use previous month's oil prices to calculate the current month's inflation. We can actually forecast inflation nearly 2 months ahead using this, and the average figures we're going to show in the next report. But basically we're looking at inflation about 3.1% for February to be released today, and perhaps up to 3.4%, maybe even a little bit higher in March. I hope that you will take a look at our websites. I've got a blog at 1000gold.blogspot.com, which is a free blog and basically has 8 years of archives of all kinds of articles on inflation and gold and oil and the stock market, technical analysis, and a lot of other things that are quite interesting. Very short articles, very easy to understand, but also reasonably technical. And also I've got patreon.com, Bellamy Research, which has some paid articles on it for anybody who's interested in future inflation forecasts. And of course, with the usual disclaimer, this is for educational and entertainment purposes, and it does not constitute financial advice and is not a solicitation to buy or sell any financial instrument or commodity at any time. And of course, investors always have the opportunity to do their own due diligence and to consult a qualified financial advisor before making any investment decisions. So my next short report is going to be just in advance of today's inflation figure, but we're expecting basically winter spring inflation to sprout and grow in early 2017. Thank you very much for watching. I hope you'll see my next presentation, and bye for now.